Okay, so just to check and see if people are awake, can anyone name 2 central banks for me? Anybody?
What was the question, John? Sorry.
Anyone name 2 central banks?
Central Bank of Ireland, Central Bank of England.
Bank of England, yeah. They call it Bank of England, but yeah, no, good one. And just for reference, the ones that people commonly think about is the ECB, or the European Central Bank, the Fed, the Federal Reserve, and then the Bank of England, because they all have the ability to set interest rates and things like that, whereas the Central Bank of Ireland doesn't have that sort of discretion. So just in this section, we're kind of going to get into the role of central banks in the financial sector. And I suppose what I'd say here is we're kind of getting into the meat of the course. And I'd certainly read around these few slides because they're important, I suppose, for understanding the whole course. You know, it's I suppose some of the most meatier and some of the most examinable material you'll see. So the main functions of central banks are as follows. I suppose the central bank controls the issue of notes and coins, i.e. your kind of legal tender. It has the power to control the amount of credit created by banks. In other words, it has the power to control by either direct or indirect means money supply in the economy overall. The aim of this process is to achieve price stability and financial stability, I suppose. And financial stability is very much about preventing liquidity crises or situations that could cause a financial crisis, like what we saw in the global financial crisis. A central bank should also have some control over non-bank financial intermediaries that provide credit in the economy. The central bank should effectively use the relevant tools and instruments of monetary policy in order to control credit expansion, liquidity, and money supply of the economy. The central bank should oversee the financial sector in order to prevent crises, and they act as that kind of lender of last resort in order to protect depositors and prevent widespread panic or withdrawals. And you would have seen, the Federal Reserve get involved, particularly when Silicon Valley Bank in the US got into trouble earlier this year. A central bank acts as, I suppose, the government banker. It holds the government's bank account and performs certain traditional banking operations for the government, such as deposits and lending. And then the central bank also acts as, I suppose, the official agent to the government in dealing with all gold and foreign exchange matters. And just to bear in mind then, that whole concept of the Bank of International Settlements is owned by member central banks and supports them in the pursuit of monetary and financial stability through international cooperation, and it effectively acts as the bank for central bankers. So again, the Bank of International Settlements will act as the bank for central bankers. So moving on then to the first slide here, and it's I suppose again we touched on this briefly, kind of noted at the time, it's quite a busy slide, but we're going to cover the subheadings in more detail as we move through the piece. But just at a headline level, what you need to take away is that central banks have a variety of tools at their disposal, which are listed, I suppose, more so on the left hand side, and through these tools they control money supply primarily through the banking system, with the aim to ensure stable prices, i.e. they don't want inflation going completely out of control, which is clearly supportive of economic growth and positive employment. So moving on to the next slide then. So the first tool that they have at their disposal is this whole concept of open market operations. And I suppose this is really the most common means of implementing, their monetary policy, over the world. So what is this kind of open market operations? Well, that's kind of the outright buying or selling of government securities or bonds. So by injecting or absorbing liquidity into or from the banking sector, central banks are able to manipulate the short-term interest rates and then, as a result, money supply in the economy. To decrease money supply, a central bank will sell government securities into the market, and if there is more government securities into the market, their price will go down, and therefore their yield or return will go up, as you can kind of see on the top right of that chart. Then if I am a bank and I can get a good return or a good yield on a safe government asset, that's where I will invest my money rather than lending into the real economy, which is inherently more risky. Why would the central bank do that? They want to cool down the economy from overheating, particularly if inflation is running very hot. In contrast, if I want to increase the supply of money, I will go into the market and I will buy government securities. Thereby, their price will go up and their yield will go down. And if their yield goes down, that makes them a lot less attractive to banks. And as a result, banks will have the decision, well, do I invest in this very low yielding government security, or will I lend into the economy? And they will make the decision to lend into the economy. And the central bank is effectively forcing them to do that. But we did play a video on that sort of interplay on how that works during the lecture, but that's kind of a brief summary. But I suppose the main attractions of this kind of open market operation, or OMO, is that they're initiated by monetary authorities who have complete control over the volume of transactions. Open market operations, they're flexible and precise. They can be used for major or minor changes to the amount of liquidity in the system. They can easily be reversed, and they can be undertaken quite quickly. In terms of the next way banks or central banks can impact this kind of monetary policy is through a concept called discount window, and it allows eligible banking institutions to borrow money from the central bank, usually to meet short-term liquidity needs. So if, for example, a central bank is to increase the discount rate, it will be more expensive for banks to borrow from the central bank. Hence, they're likely to borrow less, thereby causing the money supply in the real economy to decline. If a central bank, on the other hand, lowers that discount rate, commercial banks will decide to borrow more, and this will increase the money supply in the economy. By changing the discount rate, the interest rate that monetary authorities are prepared to lend to the banking system, central banks can kind of control the amount of money in the system. The third one then is this whole concept of reserve requirements. So banks, commercial banks, i.e. your AIB and your Bank of Ireland, they need to hold a quantity of reserve for prudential purposes, or simplified for if something goes wrong. So cash on hand for the rainy day or for when something goes wrong. The higher the level of that capital the bank needs to keep on hand, the higher their required reserve ratio, for instance. And the lower the amount of funds available for banks then to lend out. And if there's a lower amount for banks to lend out, then interest rates for borrowers will effectively go up, reducing the supply of money in the economy. The lower then the required reserve ratio, the higher the amount of funds available for banks and the more they can lend out, hence increasing the supply of money in the economy. I suppose then briefly the advantages of that is that that kind of requirement, it affects all banks equally. However, the disadvantage is it's, I suppose, difficult for monetary authorities or central banks to make small changes to money supply using that tool. So then this chart again is a bit busy, but it kind of just goes through the channels of monetary policy transmission, and or I suppose the way central banks are able to get inflation to the target rate. And again, the generally accepted rate, central banks will say it's about 2%, and 2% is seen as a kind of a rate of inflation that I suppose promotes stable economic growth. And I'm sure there's loads of empirical evidence to why central banks use the 2% rate, but you'll see the ECB, the Fed, the Bank of England always talk about this whole concept of getting inflation back to 2%. And currently it kind of sits a bit above that at the moment in most of the major economies. So the first thing banks will do to change official interest rates is to I suppose send a signal to individuals and corporations that the price of money is going up or going down. Hence, change their expectations of what a loan is going to cost tomorrow. That change in the policy rate will also directly impact the interbank rate, which is the rate of interest charged on short-term loans made between banks. So banks typically borrow and lend money between each other in what's called this kind of interbank market in order to manage liquidity and meet kind of reserve requirements, etc. So these measures will in turn lead to changes in, or should I say, changes in bank rates. And in the middle of that slide, you can see there that the price at which they're prepared to charge on a loan or a mortgage. It also impacts asset prices, as if interest rates go up, they are attractive. For instance, they are attractive. For instance, to more people will leave their money in the bank rather than investing in property and stocks, which clearly carry risk. Higher rates will also reduce credit availability, as higher rates increase ultimate repayments, which in turn can lead to higher default risk. So higher interest rates you've seen at the moment is, for instance, causing softness at the higher end of the Irish housing market, because it makes it more difficult to borrow. Your ultimate repayments are higher and there's a higher risk of default. Finally, exchange rates. If I increase interest rates like the US Federal Reserve has done, more people will want to put money on deposit in the US, which increases demand for dollars and then obviously drives up the price of the currency in question. And this is what's happened for most of this year. However, the dollar has weakened substantially in the last kind of month or so, because the US central bank has signaled that they have topped out in terms of their rate hiking cycle, and they're unlikely to raise interest rates any further. So the next slide there is I suppose another quite interesting slide. So while changes in policy rates take effect relatively quickly on bank rates, asset prices and exchange rates, the impact of, I suppose, monetary policy actions on output can take anything from 3 months to 2 years. And on inflation, that can be from 1 to 3 years or more. And we can see that at the moment in the US, it takes quite a long time for the impact of interest rates or higher interest rates to feed through. And how long it takes the impact to feed through really kind of depends on public expectations of long-term interest rates and inflation, but also the extent to which, I suppose, markets have been able to anticipate the monetary policy action and factor in future price increases. This is why central bank decisions typically have to be made with a view of the future, taking into account, I suppose, associated uncertainty. Then just on central bank independence, pretty good slide, I would say. Again, there's a number of arguments for and against why central banks should be independent. The slide there is very descriptive, and I suppose that there's no value in me regurgitating it for you. So then just in terms of the summary points then on chapter 5. So again, we just noted that central banks manage the currency and monetary policy of a country or a monetary union in the case of Europe. It oversees their kind of commercial banking system and aims to maintain price, i.e. inflation, effectively, and then financial stability. We just touched on central bank tasks, which include, issuing notes and coins, controlling the amount of money created by banks, acting as a lender of last resort, etc. We also touched on the whole concept of the Bank of International Settlements, and that's owned by member central banks and supports them in the pursuit of monetary and financial stability through international cooperation, and it acts as, I suppose, a bank for central banks. We touched on the tools to manage monetary policy, be that open market operations, discount windows, reserve requirements. We also touched on the whole concept of monetary policy transition or transmission, and how it can take some time for monetary policy to feed through, and it feeds through with a lag typically. And then we just touched on, the independence of central banks, and there's advantages and there's disadvantages to that, but it's all detailed there on the slide. Okay, so chapter 7 then. So first slide here that's of relevance. So now systemic stability is one of the main reasons for regulation, as you can see there on your first bullet on this slide, as given banks key position in the financial system. The social costs of a bank failure are great, and we spoke about the whole concept again that credit is the lifeblood of the economy in many ways, and banks are the conduit that ensures that lifeblood gets around the system. So what's this whole concept of systemic risk? Well, I suppose it's a concept that a problem in one bank will spread to the whole sector, and where the failure of one financial institution has financial repercussions to others, thereby threatening the stability of the financial system. So not too surprisingly, or not too unsurprisingly, that whole concept of financial stability became quite a common theme post the global financial crisis. The moral hazard aspect, I suppose you can see on the right hand side, comes in when you think about that whole concept is too big to fail. Well, if management think the government is going to bail me out if things go wrong, well, they're going to be less careful. The second concern there on your slide is the whole concept of kind of trying to maintain safety and the soundness of financial institutions. And this concern is, I suppose, at the core of the whole concept of your microprudential regulation, which relies on the view that if banks do not take excessive risk, the financial system will be safe and the real economy will not suffer from financial crises. And then the final concern there is about protecting the consumer. So in financial markets, the whole concept is let the buyer beware, but that's not considered adequate, as financial contracts are oftentimes very complex and opaque, or I suppose difficult for Joe Soap to understand without a master's degree in finance, or having completed maybe this module in some instances. And the cost of acquiring information is high, particularly for small and retail customers. So you've got consumer protection is a particularly sensitive issue if customers face the loss of their lifetime savings. So then finally, you've got regulation serves the purpose of protecting consumers against the abuse of monopoly power and product pricing. And we've kind of touched on that in the concept of maybe the Irish banks, where they effectively have an oligopoly and maybe in some respects control both deposit pricing and mortgage pricing to some extent. So then there are a number of different types of regulation, and this kind of slide just touches on macroprudential regulation and microprudential regulation. So your macroprudential regulation, I suppose it's top down regulation aimed at ensuring that the overall financial system remains resilient, and it also limits the build-up of this kind of systemic financial risk that we talked about on the previous slide. And as a result of that, as a result, should I say, of these kind of macro-prudential policies, they aim to ensure that kind of your large, global, systemically important banks are subject to more stringent prudential requirements than smaller players. Because of this, because if one of these banks fails, it could cause problems in other banks as well. So can anyone name me any of these kind of global, systemically important banks? And you can look it up there on the internet or on Google if you want, and come back with one, or just think of one of the large global banks, and I'll tell you if you're right.
Wells Fargo.
Wells Fargo would probably be one. The other ones that you'd think about would be the likes of JP Morgan, Bank of America, Citibank, HSBC would be some of the top ones. But I'd just be cognizant of that whole concept of globally systemic important banks. So why is the regulation more stringent? I suppose this is because, as I said, the failure of any of these institutions would have a serious consequences to the financial system and the economy as a whole. In contrast, then, we just touched on the whole concept of micro-prudential regulation, and this kind of the whole concept of micro and macro kind of ties back into economics. But this is more of a, I suppose, bottom-up monitoring and supervision of financial institutions. Particular attention being paid here to asset quality, capital adequacy, which in turn should ensure at a micro or bottom-up level that consumers are being protected. And most of this kind of macro and micro prudential rules, they kind of complement each other, as individual banks will have to be well run in general for the financial system overall to remain sound, hence why the policy tools on the side generally overlap. However, you will see that the micro-prudential policies adjust, for instance, capital-based on individual institutions risk, for example, like for instance, they'll have a capital conservation buffer. So when banks incur losses, that capital conservation buffer guarantees that they have like an additional layer of useful capital to draw down as a cushion. But in most instances, you'll see there that the two tools and the requirements overlap both on the micro and the macro side. So just looking then briefly on this slide, and it just goes through the examples of the financial safety net. So the financial safety net, this is a kind of a comprehensive system for enhancing and ensuring the country's financial stability. It consists of 5 elements listed on the slide. So the lender of last resort, we spoke to the whole concept that the central bank will provide funds to banks that are in financial difficulty and are not able to access any other credit channel. The lender of last resort normally operates at a domestic level, but the growing internationalization of banking institutions and the banking and financial crisis have raised the issue of, having an international lender of last resort. But I suppose no firm decision has been made on that. In terms of bank insolvency, most countries have enforced a bankruptcy law or insolvency regime aimed specifically at banks and financial institutions. You've got cooperation and a resolution process, so the viability of a safety net in case of a crisis also depends on efficient communication and cooperation between all network elements that can be seen on this slide. And this requires appropriate standardization and clearly regulated processes that I suppose need to be harmonized at an international level. And I suppose that whole concept of the harmonization at an international level was kind of highlighted, the need for that in the 2007-2009 global financial crises. You couldn't just make decisions at a national level. There needed to be kind of coordinated decisions internationally to solve the crisis. With respect of then a deposit insurance scheme, that kind of just guarantees all or part of the amount deposited, should I say, by savers in a bank that will be paid in the event that a bank fails. And we noted, for instance, in the Irish example, up to the first 100k is fully insured by the central bank in the event that, for instance, AIB was to get into trouble. You know, if you've got up to 100k in there, that's guaranteed. Just on the next slide, then we just touched on this whole concept of the measures of bank capital, and the chart, I suppose, just demonstrates the different levels of bank capital ratios. So total capital to risk-weighted assets. So what is your risk-weighted assets? So essentially, your risk weighting will be applied to different asset types to reflect their level of risk, with cash clearly having no risk, while something like a mortgage or a corporate loan having a higher level of risk. So if you think about it on a gradated scale, cash has no risk, a personal loan will be very risky, and then a mortgage might sit in the middle because you've got security on a mortgage, whereas you might not have on a personal loan. As a result, if you're undertaking a lot of risky business, you will need more capital on hand than if you're a bank that's not taking on as much risky business. And we touched on the whole concept of tier 1 capital, and that's a core measure of a bank's financial strength from a regulatory point of view, and it is the highest quality and most liquid capital on a bank's balance sheet. We then just touched on, I suppose, Basel III, and Basel III essentially aims to strengthen regulation, supervision and risk management of the banking sector. Basel III just really built on what happened in Basel I and Basel II and tried to correct for the flaws that were inherent within the first two Basel frameworks. And the Basel III Accord, I suppose, it addressed several issues. I suppose it proposed many new capital, leverage and liquidity standards to strengthen the regulation, supervision and risk management of the banking sector. And you can see there on the chart that under the Basel III, the capital ratio requirement increased. The eligibility of capital has been kind of tightened up. So, you know, you're reducing, I suppose, the type of capital that can be used to meet your kind of tier 1 capital, etc. So there are kind of some brief takeaways. In terms of this slide, then you can just see this Basel III. There was a 3-pillar approach to Basel III. So under Pillar 1, there was higher minimum capital requirements with respect to tier 1 capital introduced, as it was found in the GFC, for instance, that assets that were previously classified as tier 1 couldn't absorb losses or were not liquid enough to absorb losses when they would occur. It also saw the introduction of the whole concept of a capital conservation buffer, or an additional layer of usable capital that could be drawn down when losses were incurred. We also saw the fact that liquidity and leverage ratios were also introduced and had to be disclosed, so regulators could have a fuller picture, I suppose, of the risks or lack of risks that banks were taking on. And the aim there is kind of clearly to improve the bank's ability to absorb shocks arising from, I suppose, financial and economic stress, whatever their source. The Pillar 2 then is essentially about the supervisory powers of the national regulators. That was enhanced, became more sort of wide-reaching, I suppose, and they have a review process for bank-wide risk management and capital planning. And I suppose the aim there is to improve risk management and governance within the banks themselves. And then finally you have that Pillar 3, which was just I suppose further enhancing the risk disclosures that were evident from the Basel II. Then just in terms of the components of regulatory capital, so I'm not really going to get too focused here on the jargon, but just under the Basel Accord, minimum capital as a proportion of your risk-weighted assets had to be around 8%, which is a combination of your tier 1 and tier 2 capital. However, the majority of that 8% had to come from your tier 1 or your most liquid capital, and your tier 2 capital is just a bit less liquid, and you mightn't be able to liquidate it quickly in times of crisis. But there's a lot of there's a lot of narrative detail on that slide, and I'm not going to regurgitate it for you. So then, just in terms of the summary points, so we just kind of touched on the main reasons for financial sector regulation, I suppose, and it can be to ensure systematic stability, to ensure the safety and soundness of individual financial institutions, and to provide smaller or retail clients for protection and to protect consumers against monopolistic exploitation. Systematic risks arise where problems in one bank spread to the whole sector and thereby threatening the stability of the financial markets. You've got your different measures of capital, be it tier 1 or tier 2, and they'll also be looked at as a percentage of risk-weighted assets, and we talked about what risk-weighted assets are. And then we just briefly touched on Basel III and the whole concept that it just essentially aims to strengthen regulation, supervision and risk management in the banking sector, and just builds on any of the weaknesses that regulators found from Basel I and Basel II. And they do this through a 3-pillar approach, the details of which were covered in the slide. Last chapter, okay. So last chapter then for tonight. So in terms of banking crises, so there's a number of causes for banking crises or banking failures. It can be down to poor management, it can be down to fraud, it can be down to regulatory forbearance, and can be down to that whole concept of too big to fail. We've briefly touched on management. Poor management can cause problems on the asset side of your balance sheet. For instance, if the management lets their relationship managers write a lot of bad loans, well, you're going to have problems down the line. If you're not effectively managing your liquidity, you're also going to have problems on the liability side of your balance sheet. Fraud then has long been kind of recognised as the single most important contributor to bank failures, both in the past in the present. But oftentimes it can be difficult, should I say, to distinguish between what was fraud versus what was just excessive risk taking. We touched on the fact that there was a study done by the US House Committee of Government Operations, and they found that 50% of bank failures were in the 1980s were actually principally due to the whole concept of fraud. So it is a very important I suppose concept in the whole field of banking crisis, and it can often be quite difficult to ensure or to convict based on fraud, because there's a very fine line between what would be seen as fraud and what would be seen as purely bad management, as we touched on above. Another reason then for bank failure is this whole concept of regulatory forbearance, where I suppose bank auditors and regulators miss important signals. The
slides aren't moving.
Yeah. Oh, sorry. Pardon? Was that a question?
No, we're still on the same slide. I didn't know if you wanted to move on from.
No. It's
sorry.
It's still the same slide. This is just it's all kind of more detailed in the slides from the chapter itself.
No problem.
So so regulatory forbearance. So this will be like when bank auditors and regulators miss important signals from the distressed bank, or they put the interests of the regulated bank ahead of taxpayers, and they're guilty of forbearance. Some would argue this happened with respect to the Irish Central Bank and Anglo, for instance. Then finally, we have the concept of the too big to fail. And that describes a situation in which a business is so deeply ingrained in an economy that its failure would be disastrous to the economy overall, and therefore the central bank has to kind of go in as a sort of a lender of last resort. And as we noted previously, if you know the government is going to bail you out, you might then end up taking excessive risk. And we saw the fact that the likes of Merrill Lynch had to be bailed out in the GFC, and I suppose the government effectively, the US government effectively forced Bank of America to buy it out, and AIG, the insurer, which you would know from sponsoring the Dublin football team, also had to be bailed out at that time. So in terms of what do regulators do to monitor banks' risks and attempt to prevent these crises, well, they look at this kind of early warning system model. In the US, bank supervisors rate an individual bank's overall safety and soundness to produce what are called CAMELS ratings. And a CAMEL is obviously just an acronym for what you see there on the slide. And it's capital adequacy, asset quality, management quality, earnings, liquidity, and then sensitivity to market risk. The ratings are only disclosed to bank senior management, but they would be made public if a bank fails. Some of these CAMELs we've talked about before. So, the tier 1 capital is very liquid very liquid assets. Asset quality is, the percentage of loans that are not paying you or are non-performing, and that's an important concept to remember. The whole concept of a non-performing loan, and a non-performing loan that is effectively, if you're the bank, it hasn't paid you the capital interest payments that they were meant to do for a number of months. That's a non-performing loan. Then earnings, returns you're generating on your assets, and the net interest margin or net interest income. And that's the difference between what you're paying to depositors versus what you're taking off your borrowers. And we will kind of cover that a bit more detail when we go into the slides next week that goes into a bit more detail on that. Then the next slide just goes into bank resolution terminology. So I suppose despite regulators' best efforts to identify vulnerabilities in the banking system, bank failures do still happen. And a crucial question on bank regulators' minds is, what is the best policy option for rescuing a troubled bank? There is never, I suppose, a one-size-fits-all, but ultimately the goal is to restructure the bank in a way that has the most minimal impact on the taxpayer overall. And this table just draws out the different types of resolutions which you could go through. And again, I would say, I would definitely pay attention to these two slides, because there's some very good material on there. Okay, so again, I'm not going to regurgitate those slides for you. As you know, it's all virtually narrative. Now, in terms of bank resolution methods, and again, this is another good slide, and I suppose it covers a lot of the material very succinctly in terms of the pros and the cons of different resolution mechanisms. And I suppose, remember, there is no one size fits all. But just briefly, I suppose a liquidation is when a bank is no longer viable. And if a rescue is not possible, there is no prospect of restoring its kind of to long-term viability of the bank. The bank may just have to be liquidated, and the positives and negatives are there, and you can read those in your own time. There's this whole concept of purchase and assumption that you'll see kind of halfway down. And I suppose this is one of the most efficient methods for resolving troubled bank, and I suppose a P&A arrangement essentially involves a healthy financial institution purchasing some or all of the failed institution's assets and assuming some or all of the institution's liabilities. So I would think of something like Bank of America taking over Merrill Lynch, and then you also have a bridge bank. But again, lots of really good detail. I can't improve on how well laid out and easy to read that slide is, and it's a good slide. So then just a summary there would just be summary points for this chapter then. Reasons for bank failures include, as we said, poor management, fraud, regulatory forbearance, and too big to fail. Preventative measures, bank supervisors use this kind of CAMELS rating as an early warning sign to identify potential problems before they occur. Banks will still fail despite all this, and there's different resolution procedures, be it liquidation, M&A, bridge banking, etc. And I did also highlight, just if over the Christmas ahead of your exam you want to take some time off, but also do some active learning or non-active learning. Those films are obviously very useful in making a lot of the jargon that I've talked about a lot more understandable and will help you in your exam. So that kind of covers off the summary of the first 8 chapters. Was there any questions?